A rancher in West Texas leases out 30 acres of bare dirt. No cattle, no crops, no irrigation. And it pays him more in a year than the 3,000 acres he actually farms. The land does nothing. The check still shows up, drought or not, cattle prices up or down. A solar lease pays $800 to $1,000 an acre a year against $40 or $50 from grazing the same ground. But that check isn't really about him. Somewhere behind it sits a company that spent $90 million, waited 5 years for a permission slip, and is betting the next 25 years on a government that won't change its mind. This isn't the rancher's story, it's theirs. Owning a solar farm has almost nothing to do with sunshine. It has everything to do with contracts, timing, and a waiting line. And almost nobody explains that part before the ink dries. So what is a solar farm, really? Think of it as a factory that makes nothing but electricity around the clock with free raw material and almost no staff. A 100-megawatt plant, a fairly standard size in the US and Australia, sits on 500 to 800 acres of tilted panels, some mounted on trackers that follow the sun across the sky. That's enough to power roughly 15 to 20,000 homes. No chimney, no fuel truck, no factory floor. Just glass, aluminum, wiring, and one very expensive connection to the grid. It sounds almost too simple. That simplicity pulls investors in fast, right before the complexity of actually building one hits them. Getting a solar farm out of the ground isn't cheap, and in 2026, it's gotten more expensive, not less. Utility-scale solar now runs roughly $900,000 to $1.6 million per megawatt, once you count panels, inverters, mounting structure, wiring, and labor. So a 100-megawatt project can cost anywhere from $90 million to over $150 million before a single watt reaches the grid and before land. Here's the cost almost no first-time developer sees coming. Interconnection. That's the fee to physically and financially tie your farm into the existing grid. And in some states, utilities now ask developers to fund multi-million-dollar substation upgrades just for the right to plug in. Nationwide, the queue of projects waiting just to be studied for a grid connection sits above 2,000 gigawatts, down from a peak near 2,600 a couple of years ago, but still enough backlogged capacity to double the country's entire power grid if it could all get built at once. It can't. Some projects wait the better part of a decade. In plain terms, the sunshine is free. The permission to sell it isn't. Remember that line. It's going to matter again later. Say a farm clears that gauntlet and gets built. Now one decision shapes everything else that follows. Who buys the electricity? And at what price? For how long? Most large US and Australian solar farms sign a power purchase agreement, a contract locking in a buyer, usually a utility, a tech company, or a big manufacturer, for 10 to 20 years at a fixed price. That contract is why banks will lend hundreds of millions of dollars to a project with zero revenue history. It turns a field of panels into something that behaves, on paper, almost like a bond. Some developers skip that safety net and sell straight into the wholesale market instead. When the grid is thirsty, that can pay far better than any long-term contract. When the sun is out everywhere at once and prices go negative, it can pay nothing at all. That second path is where a lot of amateur solar investors get burned. Revenue itself usually comes from 3 separate pockets, not one. Pocket 1, the electricity itself, sold under that contract or on the open market. Pocket 2, government certificates that reward clean generation. Renewable energy credits in the US, large-scale generation certificates in Australia. Each one represents a megawatt-hour of clean power. And this is where you can watch the industry's risk play out in real time. LGC prices in Australia spent years trading in the 40s and 50s, but by early 2026, they had collapsed to single digits, as low as $4 or $5, on oversupply and the scheme's approaching shutdown. A 100-megawatt farm that once expected several $1 million a year from certificates alone can find that income has nearly vanished. Same panels, same sunshine, a completely different check. Pocket 3, often overlooked, capacity payments. Some grid operators pay a plant simply for being available when needed, whether or not it actually generates that day. A smaller check, but a steady one. And in tight grids, it's grown from an afterthought into real money. Stack all three together, and you start to see why solar farms, boring as they look from the highway, can post genuinely attractive returns when all three pockets are actually paying. Day-to-day running one of these places is almost eerily still. No shift of workers clocking in every morning. A remote monitoring team, often hundreds of miles away, watches performance data streaming in from every panel string in real time. A skeleton crew handles mowing, cleaning, and the occasional inverter fault. A handful of people can run a facility worth well over $100 million. That stillness is exactly what draws pension funds, insurance companies, and family offices to solar in the first place. An asset that behaves like a utility and gets priced like infrastructure. It's not glamorous, it doesn't make headlines, and for 25 years, that's supposed to be the whole point. Supposed to be. Because underneath that calm, 25-year contract math, there are costs the brochures don't dwell on. Inverters, the electronic hearts that turn direct current into usable power, typically need replacing once, sometimes twice, over a project's life, at a cost that can run into the millions for a large farm. Panels degrade too, lose roughly 0.5% of output every year, and a plant running at full rated output in year 1 is down closer to 90% by year 20, sometimes less, if the real-world degradation curve runs steeper than the spec sheet promised. Hailstorm insurance, as extreme weather gets worse, has climbed sharply in some U.S. states, enough to meaningfully dent annual margins. Vegetation control, wildlife fencing, security patrols, all of it adds up over decades. And in both countries, developers increasingly have to post a decommissioning bond up front. Cash locked away to guarantee the land gets cleared when the farm eventually retires, sometimes tied up for a very long time before it earns a cent of return. None of that is fatal on its own, but stack it against a wave of policy risk that's gotten sharper, not softer. In the U.S., a sweeping tax law passed in mid-2025 compressed the timeline for the federal 30% investment tax credit, the subsidy that's underpinned solar economics for over a decade. Projects that break ground by roughly the middle of 2026 lock in a longer runway to finish construction. Start later, and the credit only survives if the project is fully operational by the end of 2027. Either way, that deadline has turned timing into as real an investment risk as sunshine ever was. In Australia, you just watched that risk happen in real time. The certificate scheme is winding down for good after 2030, and prices have already cratered years ahead of the actual shutdown. Every project financed today has to underwrite around that. Add interest rate sensitivity since these projects run almost entirely on debt. Add grid congestion, which can force a farm to curtail, literally switch itself off, when there's too much solar flooding the grid at once. Add the very real chance of a hailstorm shredding a season's worth of panels. The picture looks a lot less like free money than the pitch decks suggest. Real projects show both sides of that coin. Topaz Solar Farm in California, 550 megawatts, built by First Solar, eventually owned by Berkshire Hathaway Energy, has run for over a decade as one of the steadiest assets in that utility's entire portfolio. Proof that scale and a strong, long-term buyer can make solar genuinely, profitably boring. In Australia, Neoen's Numurkah solar farm in Victoria has fed the grid successfully for years under long-term contracts. Now picture the other version of that story. A smaller developer signs only a short-term contract or skips a proper interconnection study to save time. The land option is bought, the permits are filed, the panels are ordered. And then the real interconnection cost comes back at triple the estimate. Or the queue position pushes commercial operation out 5, 6, 7 years. The project sits half-built, bleeding carrying costs on land and permits that can't be recovered. And by the time it finally connects, the tax credit window has closed, and the return that modeled at 12% prices out closer to zero. The developer who assumed sunshine was the hard part learns that permission was. Look at enough of these failures, and the same mistakes show up again and again. 1. Treating interconnection as paperwork instead of the central risk of the whole project. You already know why. 2. Running the numbers on year 1 output straight across 25 years, as if panels never age and certificate prices never move. A third mistake trips up smaller investors specifically, buying into a land lease without checking who actually holds the mineral or water rights beneath it. That single gap in the paperwork has killed more than one promising deal before construction even started. So, after all of that, what does the actual return look like? Well-structured utility-scale projects with strong long-term contracts typically target unlevered returns in the high single digits. That's the return before any borrowed money is involved. Levered equity returns are a different number, the one that matters most to the investors putting in the smallest, riskiest slice of capital, after the project has borrowed heavily against those long-term contracts. Because debt lets a small equity check control a much bigger asset, both the wins and the losses land harder on that slice, which is why levered returns often land between 10 and 15% over the life of the project, once debt, tax credits, and certificate revenue are all layered in, assuming the timing behind every one of those numbers actually holds. It's not the kind of return that trends online. It's the kind that compounds year after year while demanding almost no attention, which, if you're a pension fund managing someone's retirement 40 years out, is exactly the appeal. So, strip away the panels, the acronyms, the acreage. A solar farm is a long-term bet dressed up as a power plant. A bet that sunlight keeps falling for free, that governments keep buying clean power on paper even while they argue about it in public, and that some grid operator somewhere will always need one more megawatt when the afternoon peak hits. The rancher mowing grass under those panels was never really in the electricity business. He's renting out patience, one contract at a time, and getting paid handsomely for the wait. Everyone else in this story is being paid for the same thing, for correctly guessing which 25-year bet on paperwork actually pays off. So here's the real question, the one worth sitting with. If the sunshine was never the hard part, would you have known to check for the part that actually was?